our panel today, we're going to be discussing diversifying our portfolios in the post-pandemic economy, which will include REITs. So a little issue there with the panel title, but we'll get into this nonetheless. So I have some great investors here that are friends of Benzinga, and we had a discussion about investing in the post-pandemic recovery and some things that investors like you guys, traders like myself and others, can kind of use to determine what sectors are going to grow coming out of this, and some leading indicators that we can all look at and capitalize to find some alpha. So without further ado, I want to introduce our panelists. We have two firms with us. We'll start with Sandra and Christian from Firm Impact Partners. Please give us a little rundown of what you guys have going on.
Thank you for the opportunity, RJ. So Firm Impact Partners is an investment manager focused on positive impact themes that will be changing the world in years to come. We've developed a suite of liquid equity investment strategies and private equity solutions to preserve and grow investment capital while paving the way for an effective bridge between successful asset management and real impact in underserved communities.
Great. And now let's hear from my friends over at White Lion Capital, Dimitri and Sam. Great to have you guys.
Absolutely. Thank you, RJ. So I'm Sam Yaffa. And I'm Dimitri Slobodski. So we're two of the four founding partners of White Lion Capital. We're a Los Angeles-based family office that focuses on making principal investments into companies that are based in trending sectors. So far in 2021, we have made several investments, both domestically and abroad, utilizing all types of investment structures and different investment strategies.
Great. Thanks for coming, everybody. Let's dive right into it. I think one of the more interesting discussions that we had the other day was around some of the economic indicators and some of the things happening post-pandemic that we're reacting to. So I wanted to start with Sandra and Firm Impact. And let's talk about some of the Black Swan events that we all brought up and just outline those and give your take on that and how that affects what we're going to do with our investments.
Thank you, RJ. We would rather say it's major geopolitical events that we are keeping an eye open. So very specifically, the ongoing effect of the Delta variant and what's happening currently in China. We know there's at the moment one of the biggest buildup of container ships in the port of Los Angeles today. It's almost at the same level as of in February, and that would mean higher prices to the consumer. So supply lines certainly being squeezed, and this is just one or two ports that's being affected in China. So we are keeping an eye open on that. Obviously, that will have a transmission effect on higher inflation. And then from a Chinese regulatory landscape, China has come up with some very big nationalization type announcements that just came out. And what's interesting here, if you just look at what's happening on the education sector, some of those names have lost 2/3 of their value. So very important to know where you're invested in. But also from a positive perspective, there is an eye to see if China's really following the German industrialization complex, which is really focused on technical education instead of higher education, and really creating jobs in factories and in industry itself, instead of having this big bulk of youngsters heading to universities and not really having industrial jobs for them. So there's an opportunity with the caveat of the clamp on higher education type training and education companies.
Great. Thanks, Sandra. And Sam and Dimitri, you guys also had an interesting take on how nationalization in China might affect some sectors. I wanted to make sure we touched on that.
Absolutely. So there is a bit of a silver lining with the Chinese nationalization. And that is, if you think about the U.S. markets, the U.S. financial markets has a legacy and there's a long history. Whereas with the Chinese financial market, it's important to understand that its unprecedented growth is something that the Chinese regulators are just trying to keep up with. You look at the modern day cryptocurrency market of what the U.S. regulators are dealing with. They could never expect it growed at such an insane rate that it did. So it's almost the same thing going on in China. Those regulations haven't really been put in place yet or matured to a point that they're able to control the unprecedented growth going on. So from what's going on in the world perspective, we have what's going on in China. Obviously, it's important to note, as this is now developing over the past couple days, is what's going on in Afghanistan with the new government and regime taking over there. And it's really interesting that China actually recognized the Taliban as the new government system over there. So, there's a whole bunch of things going on in the world that are just complete black swan events. And this should also be taken in consideration with, your investment criteria and due diligence.
Right. And taking a step back and looking at how inflation is playing a role into this, a lot of people and a lot of investors are taking a very bearish approach towards inflationary risk. Well, as CPI is inching higher and inflation is following suit, you're going to see that investable assets are also going to be increasing in value as well. So if you take the timeline of, let's say, equities, you're going to stretch it out to about March. From March until now, you're going to see that equities and both bonds have appreciated since then. Well, then you can also pose an argument that due to inflation, the returns that you're achieving aren't risk adjusted. And I believe that if you take your returns and adjust it for risk or adjust it for inflation, then you're still going to be netting a positive return at the end of it. So personally, I'm very bullish in this market and the direction we're going towards.
Thank you. So is there anything else you guys wanted to touch on about the economic indicators that we had talked about before we move on to the next topic?
Sure. So I think it's very important to note as an investor what macroeconomic factors are most influential to this current economy. So the big three are the CPI. Every single day, every time there's a new readout on the CPI, it's at a new all-time high. So one, CPI. Secondly is your monetary base and M2 money supply. So what the CPI and the monetary base and M2 money supply are telling us is that there's a whole bunch of US dollar. There's a whole bunch of money that is going into our markets. And now it's about finding and identifying opportunities and companies that are trading that perform most favorably given a high CPI environment, a high M2 or monetary base environment. So we'll touch base in a moment on some of those sectors that we believe are most impacted influentially with those current macroeconomic factors.
Yes, and just to add, we look at currencies and various currency pairs and their performance against the US dollar, as well as interest rates and whether interest rates are exploding in the short end or not. And to us, those are leading indicators and whether it could be imminent to either a stock market acceleration or a sell-off. So we are really trying to be very aware of those as in leading or lagging indicators that will help us de-risk ahead of time.
Great. Thanks, Sandra. All right. So we also talked about some of the stimulus that went into the economy as we went through the pandemic, how that affected investing and some sectors, as well as the new focus of the new administration on clean energy and introduced legislation pouring a significant amount of money into some specific areas of electric vehicles and sustainable energy. So I wanted to start with the guys over at White Lion and just have you touch on what you talked about with the stimulus causing that V-shaped recovery and how that has changed what you guys are doing.
Absolutely. So stimulus, in essence, is a double-edged sword. On one hand, as we see with the monetary base and CPI, there's additional US dollars stimulating the economy, right? It's inherent in the word itself. However, on the flip side of all of this stimulus is how are we going to pay for these printed dollars? Is it going to be through increasing debt and thus increasing interest rates because we're borrowing so much money and the Fed doesn't have as beautiful of a balance sheet as it's always had? Or is it going to be through the increase of inflation or paying increasing taxes? So this is a little bit of the balancing act that the new administration has to figure out with its fiscal policies. As we're aware, the Biden administration wants to increase taxes if you make a certain income. In addition, they want to get rid of the step-up basis on inheritance. So these are all things that need to be taken into account. Although we see the markets hitting all-time highs, it seems like every day. Although we see the stimulus positively impacting the markets, and if you look in hindsight, it was probably the best thing that needed to be done because we saw the V-shaped recovery that we've had since March of 2020. So it's a necessary evil, I guess you can say for now, but there is going to be a flip side of effects of increases of taxes and things of that nature. But yes, there also, more silver lining. There are going to be sectors that are going to benefit positively from the stimulus.
Yeah, and some of those sectors that we saw early on this year, seeing major bull rushes, you have things such as clean energy, solar, for example, where you saw companies where you take a look at them internally. These companies are either producing very to little no revenue, or they're just purely startups that went public just to raise capital. So what went ahead and happened is that these companies took advantage of all this popular press. Valuations went through the roof, and these companies started raising capital at a very fast rate. This is a good thing, though, in terms of investor, because these companies are raising capital to further along business plans and create innovation in sectors that are very hot and are needed moving forward in just the terms of the US as a whole. And what happens with all these clean energy companies? Well, a lot of revenue stems from government tax credits. As these companies may not be fundamentally strong yet, as more people believe in clean energy, more people sign up for solar, government tax credits are going to keep on increasing, in turn increasing revenues for these companies. These companies will start to slowly change fundamentally as their balance sheets start to look better and better. So moving forward, although clean energy has come down from all-time highs, you're going to see a slow comeback, or maybe not so slow, but you're going to see them come back to valuations to where it's more reasonable. People are going to start looking more so on what the companies look like internally. Do the key ratios line up? Do the multiples line up? And how are these companies going to make an impact on the future?
Yeah, thanks for that, Dimitri. And from my notes, I was mentioning this infrastructure bill coming out that could pour $40 billion into some areas of EV, and you gave an interesting perspective about how with everything going on in EV right now, it's kind of hard to really choose the winner of that battle. And I just both of you had an interesting discussion on that. I wanted to touch on that one time.
Yes, thank you. So getting on with the EV part, absolutely, it's very difficult to pick the winner in the EV area, which is why we would also look to expand that and look at things such as the extraneous, the parts that go into EV, so charging stations, battery components, technologies that go into the EV cars. We often find that what we do is once we've picked the sector using our process, which we'll get into later, we then identify the strongest candidates within that sector, as well the parts that support that sector or that area or that name. So we have a proprietary selection scoring system. Names may on the surface may look to be great names, but they may have, as the White Line gentleman brought up, they may have run ahead of themselves. We use fundamentals, we use impact or ESG, we use technicals, and the technicals will show, combined with the other two, when they run ahead of themselves. As well, we look at areas that may affect the name, such as controversies, which in some of these may be privacy issues, or fundamental issues such as high debt to equities. So we're very selective in our process, and we have a very process-driven way of picking stocks.
Great. Thanks, Kristen. So I want to move on now and just talk about some of the sectors that we were discussing that, you know, we've seen growth in, or we expect we might see growth in the post-pandemic recovery as we get there anyway. So I just wanted to start White Lion, if you guys want to cover some of those areas that we talked about and go into a little detail.
Right. So, RJ, as you know, this conference is a reopening stock summit, right? So what is going to, what stocks are we looking at? What sectors are we looking at that are going to flourish in a post-pandemic world? Now, if you're not scared already by what our conversation is and what we're talking about, what's going on in the world and macroeconomic factors and taxes and things of that nature, that's actually inherent to how I'm investing my own capital. So what I've actually done is shifted, although White Lion as a fund and us as a fund, we do try to align ourselves as best as possible with companies and trending sectors. So as opposed to just jumping into the sector, now I'm trying to pick and choose within those sectors or multiple sectors, how can I protect my downside? Given the current macroeconomic climate, we don't know what's going to happen on day to day. We don't know if another strain of the coronavirus is going to come out, for example. So one of the sectors that I actually like right now knocks two birds out with one stone. But I will preface it that I am potentially giving up upside to protect my downside. And that's what's important to me. But that sector right now is the data center REITs. And what that touches on is the extraordinary growth of cloud computing and data that we're using in internet alongside the booming real estate market. And on top of those two items, those two trending sectors, you also have the infrastructure play embedded within. Because as part of the infrastructure play, we are going to, the US government is going to increase internet access to all across the United States. So that only means more data is going to be needed to use. That only means more cloud computing, more cloud space is going to be needed. Every time we get the newest phone, the newest laptop, the newest television, it takes up more and more space. Well, there needs to be a data center. There needs to be somewhere to store all that memory and all that space. So I like the data center REITs right now because you knock two birds out with one stone. You get exposure to the cloud computing and internet technology markets, in addition to the booming real estate market, as we're here in not so sunny California.
Yeah, and apart from those exciting areas, we're also focusing in on cryptocurrencies, blockchain, and cannabis. And to start from the blockchain side of things, I personally see it as a very exciting space. Right now, it's stuck in a little bit of a limbo where cryptocurrencies, the tokens themselves, are coming down from all-time highs, price levels, evaluations that astronomically high. We never thought it would reach, $60,000, for example, in terms of Bitcoin. But what does this mean for innovation? Now that there's more attention towards this, more developers are coming on board, more startups are progressing. You're going to have things like payment processing platforms, where I myself can walk into a store down the street, take out my phone, and pay for something off of a coin that I mined in the office, for example, right? So you're creating currency and you're able to implement it into the real world. And I think that's a very exciting thing to look at. And then, for example, you have exchanges such as Coinbase. They're becoming US listed companies. You're going to have a transition of investment capital going from tokens themselves transitioning into equities. And I think that's going to be a very healthy form where you're able to still have exposure for cryptocurrency. However, it's going to be more so in a regulated space. So also a very healthy thing for investors. And then now going down to the cannabis side. Right now, we're I believe we're ending the tail end of federal legalization. Hopefully we're going to see cannabis become federally legal by the end of this year, but who knows? However, cannabis is a very exciting space where it's been heavily regulated before. If you remove the regulations that are imposed on it right now, you're going to have a lot more companies become public a lot more companies be able to raise capital, and you're going to see innovation in this space as well. Right now, if you want to invest into a plant-touching company, you're going to have to invest into a bulletin board company. So what are we seeing on the bulletin boards? You're seeing a lot of M&A activity where companies are acquiring storefront dispensaries in places like Denver. You have a lot of companies here in California that are acquiring delivery licenses and getting involved that way. So you're seeing a lot of transactions happen. And once all of the shackles are broken off, you're going to see all of these companies hit the listed exchanges and a lot more capital start to pour in and basically, boost the returns of investors and boost these companies as well.
Great, thanks guys. And now to my friends at Fern. So we touched also on some of the defensive sectors as well as ESG, and I think those are two very important areas that I am interested in and wanted to get your take on that for everybody.
Sure.
Kristen.
So in addition to what they were talking about with the data center REITs and cloud computing and blockchain, which we also do have an interest in and have been investing in for some time, we also have been very interested in cybersecurity for several years, well aware that right now it is the most Googled for momentum trades, but well before it was, we've been investing in cybersecurity stocks. And when we look at the area, we do find that there's a dichotomy within. So we identify the strongest ones within the cybersecurity according to our system, because you have some very good players. You have some cybersecurity names that have issues with privacy. We are also interested in ESG, including areas such as water and pollution controls, healthcare areas such as rare disease, medical breakthroughs, biotech, wellness. There is a large interest in wellness as the baby boomers continue to age, and the millennials are interested in wellness as well. The EV sectors that we talked about earlier, areas that support electric vehicles, for example, the technologies that go into these electric vehicles. It's not just batteries, though the battery components are important, and of course they have to plug in, so charging stations. So there are many different areas that we look at and then identify what we feel are the strongest names within those sectors.
Great, thank you. And then did we touch on the ESG side with the rare diseases and things like that? I know you mentioned that and I thought that was interesting.
Yes, so we are typically invested in significant levers of meaning. And one thing that we've defined in this very big transition of wealth that's happening from the boomers to the millennials over the next few years, and COVID has just come to accelerate that, is healthcare, biotech, agri-tech, and how revolutionizing how we stay healthy and live more productively. So areas such as immunotherapy, rare disease solutions, medical devices are all themes that we rank, and we would typically find any name in a particular space and just add it to our screening portfolio. And then we utilize our proprietary scoring system that includes fundamentals, impact, which includes ESG and controversy scores, as well as technical. So really defining a holistic way to look at a particular name. So not just the theme, but truly finding the best names in that theme, depending on where they are trading right now. Something that we've been talking about now for several years is that with real estate, that, and with this commercial and tech disruption happening right now, and COVID again accelerating that, it's drastically affecting the ways we work, we live and shop. And it's helping all of us, ultimately helping to reduce our footprints in the real world. So if you use an example of a downtown Manhattan community that has been forced to live on a tiny footprint, the whole community is absolutely trying to reduce ways that their footprint is, and that would typically go out to cities everywhere. And COVID has pushed out centers to where people, so if you think of all the shopping centers that is being disrupted because of the internet, those shopping centers can ultimately be changed to little Manhattans where people choose to work and live and shop and go to the gym and have their doctor. So Those are all the things that we think is exciting about this new and increased transmission effect is faster than we anticipated, and that's exciting.
Yeah, and then the corporate corporate world going to a more remote workforce is going to more of a hub and spoke model rather than very big campuses going to smaller hybrid work models. So we're seeing that also affect the real estate market. It's very interesting. Well, thanks for that. So I also wanted to discuss our unique investment approaches. I think you've heard my friends over at Fern Impact mention a 5-step process and a scoring process, and it's very interesting. I wanted to spend some time learning about that. So without further ado, please take it away.
Thank you. So we've just combined everything that we've learned in markets each over the past 25 years, and we incorporated in this holistic and highly scalable process. We run a number of long only and as well as a long short strategy. And all of that is ultimately to help affect greater impact in this world. We are pledging quite a significant percentage of our own performance fees straight for impact to go help in underserved communities. So step one, from a geopolitical perspective, we do look at currencies, credit, and interest rate indicators to tell us if this world is in a risk on or in a risk off world. And then from a bottoms up perspective, Kristen spent 12 years at a hedge fund specifically focusing on fundamentals and technicals, doing right this. And over to you, Kristen.
Thank you. Yes, the next step is bottoms up theme selection. So we have portfolios that we built out over the last 4 years that aren't necessarily all invested at any given moment, but they are portfolios that we screen, and we screen them technically to find trend strength and weaknesses within them. And then the names, the trend strengths and weaknesses within those sectors, in particular names. We then take these strong names and drop them into our proprietary scoring system that we've talked about. It comprises fundamentals, impact, which includes ESG and controversy scores, and technicals. Our feeds populate, weigh, and score the names according to the system that we have built. And so it is simply putting names into a column, and another one comes out with a number. Step 4 is the names that have scored over a 40 are candidates on the long side. If they've scored under a 20, they're candidates on the short side. So step 4 is taking those names, and if you started with roughly 200 names, you've probably whittled it down to about 15 at this point. So we take those 15 names or so, and step 4 is a deep dive into the technicals. And we look at technicals on a short, medium, and long term. We have different momentum indicators that we overlay, and we always identify entry and exit points in this step. And step 5 leads into positioning. So then we will take those selected names that we've done a deep dive on. The 15 probably have gone down to 3 to 5 names at this point. And this takes just matters of minutes on everything except the deep dive on technicals, which I've been doing for a very long time. So we then take these technical names, the 3 to 5, and we figure out how we want to position them. If it's a long-only portfolio, we can position through the options, buying a call. We can just take a position in the stock, in the equity, if the options are not priced correctly for us to want to be involved through them. And if it's a long-short portfolio and we have some short candidates, we could buy a put on it, or we could just short the stock. So we have several different ways that we can build a position. We do always adhere to our active risk management through the selection process, through when they go into the portfolio and beyond. So there is always an entry and exit prior to putting a position on. They're always identified. We always look at liquidity. We look at sizing of positions. We do not outsize them. And we constantly are reevaluating the names that are in the portfolio as well as ones that we want to put into the portfolio. So that is our scoring system. And, it takes everything that we have done over the last 25 plus years, each of us, and puts it right into one proprietary system.
Great. And how often does that process happen? Is it always in real time, or do you have?
Sure, it does happen real time, though we don't have to. So we have the long only portfolios are actively managed but passively traded. In other words, they're for a longer term time horizon. The long short portfolio is actively managed and can be actively traded. Some of the names stay in longer term, but they can be turned over on a weekly or monthly basis as well. So it really depends if they hit their targets. And also if we are trading the options, if they are monthly, obviously, then that will be conducive to a more actively traded portfolio. So it really depends on what portfolio they're in, but everything is actively managed, and it's simply turning the systems on in the morning and they run themselves.
Great. Thanks, Kristen. Thanks, Sandra. Dimitri, Sam, so about your investment approach, you are like me, looking at fundamentals, really back to basics here. I wanted to hear a little more detail about how you guys are navigating things right now and what your funds are looking like.
Right. So we talked about things like what's going on in Afghanistan, how the Chinese regulators are behaving, things like Delta and Lambda, and I don't even know how many more letters in the alphabet there are after this. But all kidding aside, right now, given what's going on in this macroeconomic environment, what's going on in the world, as I said earlier, I'm willing to give up upside to protect my downside. And RJ, there's one thing that I've learned that's worse than not making money, and that's losing money. And I'd much rather prefer not to lose money than make any money at all, right? So right now, we're going back to basics, looking at companies' true fundamentals. It was fun at the end of 2020. It was fun when there was all this stimulus at the end of 2020, when the Biden administration came in, got elected, and everybody knew clean energy and stimulus was coming and infrastructure packages. It had its time. But right now, on a day-to-day basis, we're seeing something very unprecedented, and we're seeing black swan events happen more than ever. So going back to basic investing, making sure a company can withstand macroeconomic changes and these black swan events. And then lastly, companies that actually perform most favorably given the increasing CPI and the increasing M2 money supply and monetary base. I really like going back to basics, which is our like social media based companies, software as a service companies. I already touched on data center and REITs, because those are companies that have front loaded fixed costs from a few years ago prior to all of this inflation. So you look at some of these social media companies, they built already their platform 5, 10, 15 years ago. So now they have all their fixed costs the same, but as the CPI continues to increase, they could increase their prices. So costs stay the same, increase in prices. So there's some real value with some of these companies that don't have any increased costs in this environment.
Right. And so further along the point of back to the basics, what it also means for a fund is taking valuations and setting that aside, taking multiples and ratios, putting that aside. What is at the core of every single business? And that's your key management members. So now moving forward, we're really taking the time to get to know management members, as much as we possibly can, and see, how well would these management members perform if this business model, let's say all the cash flow was pulled. Would these same management members be able to recreate something similar or something as successful if they didn't have, crazy valuations to raise capital off of? At the same time, we're also going back to the basics in the sense of, going back to just plain and simple, boring companies. At the end of the day, when you stretch out an investment timeline from, you have your monthly investors, but you want to stretch out to 10 years and build a retirement savings plan, what do you want to put into that portfolio? Personally, I would look into things such as the waste management business. It's not a hot sector. It's not trendy. Nobody even really thinks about it. But what does everyone always need? And that's things such as waste management. So it's just going back to things that you yourself know is going to be around for the long run. You want to get to know the management members of the companies that you really enjoy and see, is this a company that I want to be involved with, invested with, and grow with for the next 2, 3, even maybe 10 years.
Great. Thank you, gentlemen. Well, it's been a fantastic conversation with you all. I appreciate you joining us and sharing your wisdom. We touched on the stimulus, the electric vehicle infrastructure coming through. Benzina will be holding an electric vehicle conference in September, so I hope you all can join me on that. We'll dive much deeper into that sector. And other than that, stay tuned for the next investor panel at the next event. And Mr. Brent Slava is here to take it to our next segment.
Yes, sir, I am. Thank you, RJ. Thank you to our panelists for joining. One more time, that was building a post-pandemic portfolio. What sectors watch? Did a great job with highlighting some cool ideas there. So appreciate everyone participating. Have a good day, everybody. Thanks for joining.